Assalamualaikum warahmatullahi wabarakatuh. So I'm going to resume and explain the material what I've been watched before from the previous video. And now I will share screen first. Okay, the topic is about trainer ratio, Sharpe ratio, and Jensen's alpha measure. And the first one, I will explain about trainer ratio. What is the trainer ratio? The trainer ratio, also known as the reward to volatility ratio, is a performance metric for determining how much excess return was generated for each unit of risk taken on by a portfolio. Excess return in this sense refers to the return earned above the return that could have been earned in a risk-free investment, although there is no true risk-free investment. Treasury bills are often used to represent the risk-free return in the trainer ratio. Risk in the trainer ratio refers to systematic risk as measured by a portfolio's beta. Beta measures the tendency of a portfolio's return to change in response to changes in return to the overall market. The trainer ratio was developed by Jack Trainer, American economist, who was one of the investors of the capital asset pricing model, or CAPM. Now we will understanding the trainer ratio. Here as the formula for the trainer ratio is RP minus RF divided beta P, which is RP is portfolio return and RF is risk-free return, and beta P is beta of the portfolio. And now we will turn to the Sharpe ratio. What is Sharpe ratio? Sharpe ratio is the measure of risk-adjusted return of financial portfolio. A portfolio with a higher Sharpe ratio is considered superior relative to its peers. The measure was named after William F. Sharpe, a Nobel laureate and professor of finance emeritus at Stanford University. Sharpe ratio is a measure of excess portfolio return over the risk-free rate relative to its standard deviation. Normally, the 90-day Treasury bill rate is taken as the proxy for risk-free rate. The formula for calculating the Sharpe ratio is RP minus RF divided SP, which is the RP is portfolio return, RF is risk-free rate of return, and SP is standard deviation for the portfolio. Standard deviation is derived from the variability of returns for a series of time intervals adding up to the total performance sample under consideration. The numerator's total return differential versus a benchmark RP minus RF is calculated as the average of the return differentials in each of the incremental time periods making up the total. For example, the numerator of a 10-year Sharpe ratio might be the average of 120 monthly return differentials for a fund versus an industry benchmark. And we will turn to the last point, which is Jensen's measure or Jensen's alpha measure. What is the Jensen's measure? The Jensen measure or Jensen's alpha is a risk-adjusted performance measure that represents the average return on a portfolio or investment above or below that predicted by the capital asset pricing model, or CAPM, given the portfolios or investments beta and the average market return. This metric is also commonly referred to as simply alpha. To accurately analyze the performance of an investment manager, an investor must look not only at the overall return of a portfolio, but also at the risk of that portfolio to see if the investment's return compensates for the risk it takes. For example, if two mutual funds both have a 12% return, a rational investor should prefer the less risky fund. The enhanced measure is one of the ways to determine if a portfolio is earning the proper returns for its level of risk. If the value is positive, then the portfolio is earning excess returns. In other words, a positive value for the interest alpha means a fund manager has beat the market with their stock picking skills. And now we're assuming that the assuming the CAPM is correct. This alpha is calculated using the following four variables. Using these variables, the formula for the inference alpha is Ri minus Rl plus B or beta multiple Rm minus Rl, which is the Ri is the realized return of the portfolio or investment. Rm is the realized return of the appropriate market index. Rf is the risk-free rate of return for the time period, and B or beta is the beta of the portfolio of investment with respect to the chosen market index. So that's all from me. That's my only explanation today. I hope you understand and could get what I'm saying today. So yeah, that's it. Wassalamualaikum warahmatullahi wabarakatuh.